On September 30th, 2025, the global gaming industry witnessed one of the most remarkable events in its history. Electronic Arts, a titan of video game development and publishing, was sold for an astonishing $55 billion. This is not merely a headline for gamers. It is a milestone with deep implications for investors, technology analysts, and anyone interested in how digital economies operate. When a company of this magnitude changes ownership, it triggers waves across multiple markets, affecting stock valuations, competitive strategies, and even consumer experiences worldwide. To understand the scale of $55 billion, consider that this exceeds the annual GDP of entire small nations, surpasses the yearly revenues of most mid-sized tech firms, and dwarfs many traditional entertainment companies. This figure is a testament not just to revenue streams but also to the immense value of intellectual property, long-term brand equity, and the monetization of online ecosystems. Investors, economists, and gaming enthusiasts are asking the same questions. Why now? What strategic, technological, and market forces converge to create this historic moment? The answers lie in a sophisticated blend of corporate strategy, technological adoption, and macroeconomic conditions. Gaming has evolved from a niche hobby into a global industry worth hundreds of billions annually, with influence that touches technology, culture, and consumer behavior. In this video, we'll explore the mechanics of Electronic Arts' sale, its broader economic significance, and the lessons it offers for investors, competitors, and digital market observers. We'll also look at the implications for employment, regional economies, and the future of interactive entertainment, painting a comprehensive picture of how money, strategy, and innovation intersect in today's economy. One more thing to immediately note: this wasn't a slow acquisition. It was structured as a leveraged buyout, backed by cash, debt, and strategic investors. Understanding how this deal was crafted gives us insight into the forces that shaped one of the largest privatizations in recent history. Electronic Arts is not just a company, it is an economic ecosystem. Its most successful franchises, FIFA, Madden NFL, The Sims, and Battlefield, have generated billions in revenue over decades while building global fan communities that influence gaming culture and trends. Beyond immediate financial metrics, Electronic Arts affects regional economies through studio operations, local employment, and related industries such as software development, digital marketing, and esports infrastructure. From an investment perspective, the $55 billion price tag reflects the sector's potential for sustained growth. Analysts examine recurring revenue streams, including subscription models, live in-game purchases, downloadable content, and cloud-based platforms to justify such a premium valuation. For competitors like Activision Blizzard, Take-Two Interactive, and smaller emerging studios, this sale forces strategic reevaluation. Market positioning, technology investments, and consumer engagement strategies are now under scrutiny. The sale also mirrors broader economic shifts. Digital entertainment has become a core component of the global economy. Intellectual property, brand strength, and consumer engagement are now valued on par with tangible assets in traditional industries. Understanding Electronic Arts' sale allows us to see how intangible digital assets are central to modern economic analysis. It reveals a growing trend. Industries once considered niche are now pivotal in shaping financial markets, influencing employment, and guiding investment strategies. Moreover, this sale demonstrates the increasing convergence of technology, entertainment, and finance, highlighting that modern corporations are complex, multi-layered economic entities. And in the context of 2025, this deal takes on added weight. The gaming sector is under pressure from shifting consumer spending, inflation, and platform consolidation. For Electronic Arts to command this premium in such a climate suggests deep confidence by its buyers in both resilience and future expansion, with this transaction becoming a benchmark for how future digital entertainment deals will be assessed. To comprehend the magnitude of Electronic Arts' $55 billion transaction, we need to understand how such valuations are determined. Financial experts use multiple approaches: discounted cash flow analysis to project future earnings, benchmarking against prior acquisitions, and assessing the intrinsic value of intellectual property and brand equity. These models incorporate projected growth in subscription revenue, in-game purchases, global market reach, and potential monetization of emerging platforms such as cloud gaming and virtual reality. Timing played a critical role. Electronic Arts' strategic shift toward mobile gaming, recurring subscriptions, and digital distribution platforms increased investor confidence in the long-term profitability of the company. The macroeconomic environment further amplified this valuation. Capital was abundant, interest rates were favorable, and investor appetite for technology and entertainment assets was high. These external conditions highlight how corporate valuation is inseparable from broader economic factors. The deal structure itself is complex. It involves cash components, stock exchanges, executive retention packages, and contractual agreements to protect intellectual property. Acquiring Electronic Arts isn't just about buying games. It means acquiring creative talent, operational knowledge, global networks, and brand equity. Each element influences post-acquisition performance, competitive positioning, and long-term market dynamics. Understanding these mechanics allows investors and industry analysts to appreciate not only the financial magnitude but also the strategic implications of one of the largest transactions in digital entertainment history. In fact, here are the hard facts. The acquiring consortium is made up of Saudi Arabia's Public Investment Fund, PIF, private equity firm Silver Lake, and Jared Kushner's Affinity Partners. Shareholders will receive $210 per share in cash, a 25% premium over pre-announcement prices. The financing includes roughly $36 billion in equity and $20 billion in debt, arranged through J.P. Morgan Chase. Importantly, PIF already held a 9.9% stake and will roll over part of that into the new structure. Also, the deal is structured as the largest leveraged buyout in history, expected to close in the first quarter of fiscal 2027 after regulatory approval. The ramifications of Electronic Arts' sale will ripple across the gaming industry for years, impacting players, developers, investors, and even governments. Competitors may accelerate mergers and acquisitions to secure strategic assets, invest heavily in cutting-edge technology, or pivot development pipelines to protect market share and retain global audiences. Consumer experiences will also evolve, as new ownership could optimize monetization strategies through subscription services, in-game content, and cross-platform integration, reshaping engagement patterns and purchasing behavior. Regional economies tied to Electronic Arts operations will experience shifts as well. Studios in North America, Europe, and Asia contribute to local employment, technology clusters, and economic ecosystems. While acquisitions often trigger restructuring, they can also create growth opportunities in emerging sectors, particularly cloud gaming, esports, and augmented reality development. Talent mobility may increase, with developers, designers, and engineers seeking competitive offers across the industry, while startups and smaller studios may benefit from partnerships or acquisition interest. Regulatory frameworks worldwide will influence Electronic Arts' operational decisions. Governments monitor market consolidation, anti-competitive practices, and consumer protection measures, shaping investment strategies and operational expansion. The sale underscores the interconnectedness of digital markets. Revenue is no longer limited to direct game sales, but includes virtual economies, subscriptions, live events, and competitive gaming. For investors, understanding these implications is crucial to assessing risk, forecasting market trends, and identifying new opportunities across global digital markets. Given the debt burden included in this leveraged buyout, we may see increased pressure to optimize revenue streams, cost reduction measures, or consolidation of underperforming divisions. This could accelerate adoption of automation, AI tools, and tighter project prioritization. The shift to private ownership may allow more strategic flexibility without quarterly earnings scrutiny, but also brings intensified financial discipline behind the scenes. Electronic Arts' $55 billion sale provides crucial lessons for investors, analysts, and market observers. First, potential future growth can outweigh current profitability in technology and entertainment sectors. Intellectual property, recurring revenue models, and loyal user engagement justify high valuations, even if immediate earnings are moderate. Investors must recognize that brand strength, community engagement, and digital ecosystems hold intrinsic long-term value beyond conventional financial statements. Second, timing and macroeconomic conditions play a pivotal role. Capital availability, investor confidence, sector trends, and interest rate environments all influence acquisition pricing. Understanding how global economic conditions interact with company-specific strategies allows investors to identify optimal entry points and assess risk accurately. Third, diversification remains essential. While gaming offers extraordinary potential, economic shifts such as currency fluctuations, global trade tensions, and regulatory changes can impact returns. Observing electronic arts sale allows investors to analyze how intangible assets, consumer loyalty, and strategic positioning combine to drive valuations in dynamic markets. Finally, acquisitions generate broad effects beyond financial returns. They influence employees, competitors, investors, and consumers while shaping technology, adoption, regional employment, and digital infrastructure investments. Recognizing these ripple effects equips analysts with foresight to anticipate market shifts, assess risk, and spot opportunities across related sectors such as cloud computing, virtual reality, and interactive entertainment. Taken together, this deal reinforces that success in the modern economy lies not just in product innovation, but in building resilient ecosystems and aligning financial strategy with creative vision. For serious observers, the sale of electronic arts will be a reference point, an archetype for how future large-scale digital transactions are structured and valued. The $55 billion sale of electronic arts is far more than a headline. It is a window into the convergence of technology, finance, and global entertainment. For investors, analysts, and enthusiasts alike, it demonstrates how corporate strategy, market timing, and innovation converge to create enormous economic value. This transaction is a case study in understanding how intellectual property, brand equity, and recurring digital revenue streams drive modern valuations. Studying deals of this magnitude equips us to navigate complex markets, anticipate industry trends, and grasp how corporate decisions affect global economies. Each acquisition teaches lessons about growth, risk management, and the importance of intangible assets in today's digital economy. Electronic arts sale encourages us to look beyond financial metrics, emphasizing interconnected systems that shape employment, consumer engagement, technological adoption, and global capital flows. Ultimately, this event reminds us that economics touches our daily lives in ways we may not notice, from corporate boardrooms to the games we play, from local economies to global markets. Understanding these dynamics empowers smarter decisions, foresight, and a deeper appreciation for the complex systems driving modern industries. Whether you are a gamer, an investor, or simply curious about the forces shaping the world, Electronic Arts' monumental sale offers lessons that extend far beyond the gaming industry, showing us how money, strategy, and innovation intersect to influence every facet of the economy. Let this deal stand as a reminder: in the digital age, the most valuable assets are not always physical. They're ideas, communities, and platforms powered by data and connection. When we analyze such transformations carefully, we begin to see not just where capital flows today, but where new horizons are being charted for the economy of tomorrow.